Welcome to the 401K Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401K audit. If you have 100 eligible participants in your 401K plan, then this podcast is for you.
Welcome to today's podcast. This month, we are going to continue talking about what we talked about in last month's episode, where last month we talked about some of the common findings that we find in 401k audits, mostly related to compensation and contribution. So today, we're going to go through the rest of the findings that we find. And again, we're joined here by Kim. So how are you doing today, Kim?
I'm doing really well. Thanks, Jamie. Glad to be here.
Yeah, this should be a good one.
Yeah.
Again, I know it's a topic that people are always interested in because, again, you hear audit, that's oftentimes what you think is, okay, how am I going to get in trouble? What am I going to get caught for?
What did I do wrong?
Exactly.
And, we get asked that all the time by folks that it's their first time audit. It's so, what did I mess up? What did I? And we usually hear, did I pass or not? Which
exactly.
isn't really relevant, but we get asked that question a lot.
Pass, fail, grade, right?
Exactly.
Awesome. So why don't you start off with kind of the first ones you're thinking about?
I thought I'd start with kind of at the very beginning. If a person was going to sign up for a 401k plan, the first thing that they have to go through is what's called eligibility. And we see some errors in this area. They're not as common as some of the things we talked about last time with the compensation contributions, but we do see errors here. Most plans specify an age and or a service requirement for an employee to enter the plan. There's also some other things they can exclude, things like collectively bargained employees, so employees in a union, things like that. We don't tend to see errors on that side. But with the age and service requirement, usually specifying they have to be 18, 19, 20, 21. Those are the most common. Or maybe no age requirement. You can be at any age and enter. And then sometimes there's a service requirement. So you need to work 3 months, 6 months, a year with the employer before then you're eligible to enter the plan. So first thing off is make sure that you understand what those requirements are. Make sure that whatever your procedures are to determine eligibility, whether that's something done by the plan sponsor or by a service provider, because it can work either way. Make sure that whoever's doing that understands the rules and they're following whatever the plan document says. If you get in and you look at the plan document and it says something other than what you've been doing or what you meant, then you need to get that amended to make sure that your procedures follow what the plan document actually says. A couple of other areas that we tend to see errors, these get a little bit kind of tricky to explain, but if you have folks that are interns or more commonly seasonal employees, maybe you bring people on to work around Christmas time as an example, or maybe in the summer you have more employees and then they go away and then they come back again next year. Those folks don't necessarily get bumped out of eligibility for a 401k plan unless you specifically exclude them. And quite often we hear people say, oh, well, we don't even offer the plan to our seasonal folks, or we don't offer them to our part-time employees. That's only allowable if you specifically state that in your plan document, which usually folks don't. So an area to be careful of if you have folks that are not in your main group of employee base. The other thing that...
Just real quick, so far you've listed off some eligibility requirements. I want to make sure we're good on it. So it's okay to make sure people are eligible based on experience or time of service. It's okay to make sure people are eligible based on age, and it's okay to make sure people are eligible based off of the type of employee. So you could call out like contractors or seasonal or any of that stuff. Any other of those eligibility requirements that you see, or those are probably the most three common?
Those are the most common things we see. The other thing we run into, this isn't a plan document problem, but it's it's more of an administrative problem, is that if you're specifying the service requirement in hours, so you're saying not like 3 months or 6 months, but you're saying more like 1,000 hours you need to work, and then you're eligible after that point in time. You have to be careful how you're defining the 1,000 hours. Is it 1,000 hours in a year, or is it 1,000 hours cumulative? Because just like those seasonal folks, somebody might work 200 hours this year, they come back next year and work 300 hours. Eventually, if they keep coming back, they're going to hit that 1,000 hours. We recommend folks, if you can at all avoid setting your plan up that way, it's better for you because it just creates an administrative nightmare tracking that. But we have had a couple of plans that do that, and that's how they want it. And we just tell them if that's what you're set on, that's fine. You just need to make sure you're following, exactly what you've said.
So it goes kind of what we talked about last episode. It just goes back to documentation again. Like if you're going to have something that complicated, then you have to make sure you have the documentation ready to go. And if you can keep up with it, more power to you, right?
Exactly. If that's how you want it, then that's fine. The other thing I was going to mention, and this is on the eligibility side, again, hits the documentation that you just mentioned. We recommend folks document offering the plan to people, because a lot of your employees may choose not to participate, which is fine. That's totally their choice. But it is important that you can show that you offered them the plan timely and that they actually did decline, so they don't come back later and say, hey, 6 years ago I said I wanted to be in the plan. You never did the right thing and started withholding money. That can cause you a lot of headaches down the road and could be a regulatory nightmare. So we recommend you just have a form, and maybe they fill out and they put 0, or they check a box saying, no, I don't want to participate. Or even just keep an email. If you're offering via email, just keep the email and say, hey, they never responded, and this is when I offered it to them. It's just anything, whatever works for you.
With that area, what about like online? So I know a lot of these 401k plans are set up through the websites. Like I know ours is like if I went in there and hit 0, is that the type of documentation?
That would be, that would be sufficient. And you might be worth asking your service provider, how can I go back and see that? Right. So is there a report I can run, or I can maybe see it online? A lot of the good websites anymore will have a little screen that you can either click on, or it'll run a report saying, this person was offered on this date. And then usually there's just nothing past it because the person never even logs in, which is sufficient. That shows that they were offered.
Great. So that's kind of the things around eligibility. So what's the next area?
Yeah. Let's move on to the next topic. This is a pretty easy one. It's called Fidelity Bond. Every 401k plan is required to have what's called a Fidelity Bond. The easiest way we tell folks, if you're not sure if you have one, is to talk to your insurance provider or look in your insurance document. Look for something called a ERISA bond, Fidelity Bond, Employee Dishonesty Bond. We see that a lot. They're called different things, but it's a type of coverage that you're required to have as an employer, and it's covering the actions of the folks there at your company as they're dealing with the funds coming out of the payroll and then getting transferred over to the plan, that time in between, and to make sure that if they do anything by mistake, or more importantly, it's really there to cover some type of malfeasance, fraudulent activity, you can use that coverage to help reimburse the losses. Hopefully you never need it. The coverage isn't really very expensive, but it is an ERISA requirement. And I will say that this is a DOL hot button issue again. So something, it is reported on the 5500, regardless of whether you need an audit or not. And it is something the DOL is, it's easy for them to check. Then they'll send you a letter, and again, you can be in trouble with the regulator. So definitely worth looking into. You need to make sure you got a bond. It covers the whole year. It's the right type of bond. The Treasury Department has a list of approved providers. There's a whole bunch of them, so you shouldn't have any trouble, but you want to make sure you get the right kind of bond. And then it has to cover 10% of the beginning plan assets, or there are maximum amounts. So usually $500,000, $1 million coverage. Again, I don't want to scare anybody with those dollar amounts. What you're going to pay in premium is usually a couple $100. It's not a lot of money.
Okay.
Definitely worth checking into, because it's not worth the headache for no more than it costs your company. So coverage.
It's required for, if you're a ERISA plan, it's required that you have a Fidelity Bond. So the first thing to do is to look to make sure you have one. And so that's step one. And then if you don't have one, obviously you said there's a list of some providers. So you contact those. And then again, you want to make sure it covers the whole year. You want to make sure it's in the name of the plan and it covers 10% of assets. And so I think that's just kind of a summary of what you said. So that's pretty important to look into right now, right? This podcast should double check that right now, because that's pretty easy finding to remove.
Yeah, and it's an easy thing to do. Check with your insurance provider. If you find out you don't have it or you're not sure, just call up your carrier or your insurance agent. They can easily tell you. The other thing you want to make sure is to check the amount, because as the plan assets grow, what would have been an okay amount a couple years ago may need increased. Again, we're not talking big dollars. It's easy. Call your insurance agent. Just say, hey, I need to increase it. And some of the bonds now are kind of auto escalation. So
okay.
you just pay one fee and it'll cover you up to the max, depending on, if you'd ever need it. So those are easy fixes.
So it's probably something you should just have on your calendar to check once a year, check the amount, check the dates, and just make sure it's good to go. And it's probably a 5-minute process
Yeah,
that'll cover
it is.
you. So
Yeah.
great.
Next area we like to mention is something called discrimination testing. And I don't want to spend a whole lot of time on this because it can get to be pretty complicated. But every year, a 401k plan is required to do some testing to make sure that it adheres to, primarily these are IRS requirements. And it's called discrimination testing because one of the things it's doing is making sure that the plan isn't discriminating against, it's usually the lower paid employees. So they don't want a small business, which may have an owner or a couple of owners, to set up a plan primarily there to benefit their tax position.
Mm-hmm.
The IRS wouldn't like that. Or a large company that may do the same thing, but to benefit the officers, the senior executives. So a lot of this testing, again, I won't get into all the details, but a lot of the testing is just to make sure that it's everyone is treated equally, and it actually favors what are called non-highly compensated folks versus the highly compensated folks. So there's testing that has to be conducted. Your service provider will do that for you. You don't need to worry about how to do it. And just make sure you follow their instructions. If you have any questions as you're working through giving them the data to begin the work, make sure you ask them, because if you don't give them the right data, then the results can be incorrect, and that can cause you, again, regulatory headaches down the road. So just make sure you're following their instructions. If you have any questions, ask them. Usually those providers then will run the test and they'll give you back the results. And a lot of times they'll point out things that looked a little odd to them as they were running the test. So things like a active employee that has no compensation, a terminated employee that has compensation, an employee that has no birth date or no hire date, they have a term date but no hire date, just things like that. So you want to take a look at those. It's usually a report or an email they might send back, because maybe that stuff that was probably incorrect when you submitted the data, maybe it doesn't matter, but maybe it does. So take a look at those. If you, again, have any questions, get back to your service provider. Make sure that the test is as correct as you can make it. And then at the end of all of that, they're going to either tell you you passed all the tests and everything's good. If that's the case, I'd suggest you keep a copy of that, or you make sure that your service provider keeps a copy. You will need that for an audit. You would also need it in the case of a DOL or an IRS audit or investigation. That's one of the first things they're going to ask for. If you did not pass a test, so you failed one or more tests, there are actions that are required to be taken. And I won't go into all of those because there's different options depending on how your plan's set up. Again, your service provider will give you guidance. If you have questions, call them up, spend some time on the phone with them, but make sure you take action if required. If you don't and you leave that setting there, then it's going to cause you problems the next year because they can't. It's like there's this open thing that they can't move beyond. But also, if the IRS or DOL were to come in and take a look at your plan and or your auditor, it could disqualify the plan, which would make the plan become taxable to everyone immediately, the entire amount in their account, which obviously is a big step. You absolutely do not want that to happen. So it's very important. And these things can get very complicated. They're difficult to understand. So the best thing to do is follow the instructions, talk to your service provider, ask a lot of questions if you don't understand something. Don't just say, well, I think this is what they mean, and go with it. Make sure you really understand what's needed.
So just to clarify, so the consequences sound pretty severe, but it sounds like it's one of those nice professors in college where you're allowed to take the test, and then if you miss too many things, you can go back and correct it, right? So that's what it sounds like. Is there's options to go back and do A, B, C, and then you're going to pass the test the second time through. And then the other thing I heard you say is you want to make sure the data is correct. So if they give you 10 employees that didn't have hire dates, you could go fill out those hire dates, give them the data back, and they can rerun the test and then they come back with the results.
Mm-hmm. That's correct. Yeah, and some, depending on the complexity of your plan, the size of your plan, and if you have a lot of highly compensated people, or maybe people that get bonuses commissions, and maybe that fluctuates a lot. Providers will also let you kind of do a pre-run or preview of that testing ahead of time. That will let you know, because one of the correction methods is that the highly compensated folks have to get money back out of their plan, which a lot of folks don't like.
Right.
And of course, you got to remember, these are the owners, these are the senior executives, these are the people that you really don't want to get mad. So if your provider offers that, it's a good idea to try to take advantage of it. That way you can see ahead of time. There are things that those individuals can do to help prevent that by the time you get to the end of the year. So again, talk to your service provider, but that is an option, something you may want to consider.
Yeah, no, it definitely sounds like something that all people need to have a handle on, because the last thing you want to do is tell all of your employees that all their contributions are now taxable. So
yeah, that would not probably be a smart move.
Yeah, sure.
Next area we wanted to talk about was distributions and loans. This is obviously money coming out of the plan. A lot of times these get requested directly by the employee on the website, and the employer has very little to do with them. In and of itself isn't that big of a deal, but we recommend best practice that you take a look at those just to make sure that you're not seeing something unusual. If you just saw Joe in the hall the other day and Joe was all fine and said nothing, and all of a sudden you see, hey, Joe wants $100,000 distribution, you might want to just call up Joe and say, hey, I saw this. Did you really need this? Not that they can't take the money, but just to protect Joe, to make sure that that isn't something, maybe they got the wrong person, or it could be even a fraudster. So we recommend you just take a look at those, double check them. Distributions that are called hardship withdrawals, they're a special category of distributions. And there's been some changes around hardship withdrawals. I won't go into all the details around all of that. But that's where a person is taking a distribution. They're still an employee, and they need a distribution, just as it mentions, for a hardship. So it could be maybe they're getting potentially evicted from their home. They've got more problems paying the mortgage. Maybe they had some huge medical bills. It can also be something which isn't really a hardship, but things like going to college. So they need to pay for tuition or books or something like that. So there are some good things. They've recently made some changes for if you're having a child or adopting a child. You can, I wouldn't necessarily, I don't know, I guess you could call it a hardship. It kind of depends on how you define it, but there are some changing rules in that space as well. But there's a lot of requirements on the plan sponsor to double check and make sure that it fits the criteria. They're not taking a hardship that's too large, that you're verifying that it's a legitimate request, that they really do need it for whatever the reason is. So again, my recommendation here, if you get into a hardship request, check with your service provider, because they're going to know the most current rules and whether your plan even allows them. Maybe your plan doesn't even allow hardships, because that is optional. So things to check on. Last thing I was going to mention in this space is loans. Plans may allow a participant to take a loan against their account balance or not. Again, optional. So double check. May not even apply to your plan. If it does, then most often we see that the participant, it's a loan, so they're going to repay the amount that they've taken. Most often they have that set up through payroll. Mm-hmm. So they may still be making contributions to their plan, or they may not. Again, varies. But you're going to take an additional amount out of their paycheck every pay period to help repay the loan and along with the interest. So, that can get tricky. You want to make sure that starts up at the right time. You don't want to keep taking funds out of their paycheck once they've paid back the loan. And you're not necessarily going to know that, because that's controlled by the service provider. So it's a tricky area. If you've not had a loan before, it's your first one, you might want to give a call to your service provider, just double check. If you are going through audits on a regular basis and you have a loan for the first time, again, you could call your auditor, ask them. They could kind of walk you through the process. But just be careful, because it's going to be a little bit tricky. Timing is important. So always an area we want to double check.
Yeah, so a lot of things you talked about today, it sounds like, if a person had just a little checklist of things they could check for every month, that would be a super way to handle these things. Mm-hmm. It's okay, who became eligible this month? Did we do all the right things? Do we have all the documentation in place? Because again, we talked last time about the importance of documentation. I think kind of what I'm getting from today, the importance of just doing monthly or quarterly checks just to make sure everything is running exactly as you expect it to.
Absolutely. Yeah, put that as a good internal control, and actually it's more than a best practice. It's almost required anymore. And if you get a DOL or an IRS audit, or even just a financial statement audit from someone like Summit CPA, that's one of the things we're going to ask is who is overall responsible for the plan and what are they doing? We don't expect them to go in and be auditing every single transaction, but they do need to just do some general monitoring, make sure things are working the way that they're supposed to. And if they see anything unusual, that's really what they need to pay attention to.
So that sounds like an important topic for another podcast.
Yeah,
on internal control.
absolutely.
So before we get to I think you have a couple last items you want to talk about, but I want to make sure our listeners have our email address. So we have an email address that you can send questions to. If you want to get in touch with Kim, you can reach us there. Or if you want us to do a topic, we want to make this show for the listeners. So that email address is audit, AUDIT, at summitcpa.net. SUMMITCPA.net. So we'd love to hear from you guys and make this show as for you guys as much as we can. So any final topics for you, Kim?
Yeah, and absolutely. I'd like to echo what you just said. Pass along any ideas, something that you're really concerned about. We'd love to do a podcast for you, because if you've got a question, there's probably 100 other people that have the same question out there. The last things that I had on the list is that there are some disclosures that need to go out. Again, these vary depending on your plan and the different options that you offer as part of the plan. Those need to be distributed. That is another fiduciary requirement. So check with your service provider, and if they email you or put a to-do list on your portal that you need to distribute those items, make sure that you do it. Make sure you get it to the right people, and again, document the date that you did it, who they went to, etc. Some service providers do that for you, and that's fine. But if not, you just need to make sure that you're doing it, or someone in your HR area is taking care of that. We're coming up on a time when 5,500 filings are going to be due there for calendar year plans. First filing date's end of July. So you're probably going to start hearing about the 5,500 questions and potentially filing. So if that's the case for you, make sure that you review the 5,500. Take a look, don't just assume it's correct, because we do find errors on them all the time. Even basic things like the name of the plan. There's an EIN number, which is a tax ID number. Make sure that's the right number. If that's not right, it will cause you all kinds of problems with the IRS and the DOL. So even little things like that, just don't assume they're right. Double check them. You're not an auditor, so you're not going to necessarily audit the form, but just look for obvious mistakes. Make sure it's reasonable, the right year, and the dollar amounts look right. And the service providers do a pretty good job, but they do make mistakes every once in a while. So good thing to double check. I think the rest of the stuff is pretty much internal controls and best practices, and we're going to hit that in a future podcast.
Awesome. Well, I think this was really good information. I think these last two podcasts, like we've talked about, can really set you up for a smooth audit. I think the more findings that happen in an audit, the harder it is to go through, because you have to answer questions, you have to have follow-up questions, you have to provide additional support. So the more of these you're ready for, and just to kind of know that what we're looking for as an audit is super important. So I appreciate you putting all this together, Kim.
Absolutely. And, I always tell people it's, if you did something wrong, it's out there and it's just waiting for somebody to find it. It's better for an auditor to find it than the Department of Labor or IRS, or worst case is an employee, because that can be have all kinds of bad repercussions to you. But the best thing is to do it right in the first place. Make sure you understand what you need to do. Spend a little bit of time. I know everybody's busy, but it just takes a few minutes to double check a few of these things, and it can save you tons of time and effort, and fines and penalties and everything else in the future. So a little bit of time now is better than a lot of time later on.
Yes, for sure. And again, thanks for putting all this together. And I know it's very helpful.
Thank you.
Enjoyed this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving 401k audit success. We're here to be a resource with ever-changing rules and regulations.